Good morning, everyone. On behalf of Asian Markets, we welcome you all to the 3Q FY19 earnings conference call of Elgi Equipments Limited. We have with us today Mr. Jairam Varadaraj, Managing Director, representing the company. I request Mr. Jairam to take us through an overview of the quarterly results, and then we shall begin the Q&A session. Over to you, sir. Thank you.
Thank you, Kamlesh. Thank you, ladies and gentlemen, for taking the time off to be with us. Like it's our normal practice, I will take you through a reconciliation between our performance in the current year Q3 in comparison with the last year Q3. Sales has improved by 13% on a consolidated basis. Contribution at a material cost level has been almost the same, slightly better. And as a consequence, the overall performance at an EBITDA level seems to be almost the same level as the previous year. And this is where I would like to pause and provide a larger explanation. We have been in touch with multiple investors and analysts in terms of understanding their perceptions, expectations from our company, and one of the points that has been coming up is the promise of profitability in relation to the increase in revenue has been a bit disappointing in the company. I want to put that in context and explain to you that that's not the case. We need to look at the numbers a little deeper to understand the larger strength of the company, which is what I will attempt to do using the Q3 numbers as a context. Now, the EBITDA in the current quarter or Q3 of the current year compared to Q3 of the previous year has been pretty flat, when in reality we have grown our sales by 13% and our contribution margin has been marginally better. Why is it that the EBITDA is flat is really the question that I would like to give a context to. Now, as you know, as part of our global strategy, we've been creating initiatives both in terms of process and people. And on the process side, we've been using external consultants. And we've been increasing our headcount very judiciously but very strategically in specific locations to support the process and really roll out the strategy. So in this quarter, you're seeing a significant impact of these initiatives. So if I take those one-time costs, which are really the strategic investments that we are doing both in process and people, we have effectively close to about 138 million, which is the additional cost that has been booked in this quarter. And if I add those costs as something that is non-recurring on a steady state basis, and I will come back and talk about when we will reach that steady state, we are talking about an EBITDA of close to 610 million, which is really a growth of 30%, which I believe is a very healthy representation of performance, considering 13% growth in top line. Now, what are these one-time costs and when do we expect these costs to taper off? These one-time costs, like I said, I don't want to be very specific in terms of what we are paying to BCG because of the agreement that we have with them. But the one-time costs and the investment in people to support that one-time cost has been to the extent of close to about both combined put together is about 110 million in the quarter. This is people that we have added in the U.S. to roll out the initiatives. In addition, we have had certain one-time expenses that are more of timing in nature. For instance, a repair and maintenance in the quarter has been high, but that's more a timing issue. It will get leveled out for the year. And we are doing a big show in Hanover in April. for which we have created provisions equated throughout the 12 months. So that is also sitting there. That's to the extent of about 5 million. So if I normalize for all that, I think the operating profit is a healthy 30% growth. Now, when do we expect these costs to go away? On the process costs, which we are paying to an external consultant, we will continue on for the next year because the way we have structured the contract is the payment is, even though the initiative is for about 8 months, we are looking at a payment that is stretched out over two financial years. So the initiative will get completed end of March, but the payment is partly in 18-19 and the other part is in 19-20. So to that extent, we will see the continuation of these costs into the next year. As far as the people cost is concerned, there are two aspects to it. One is the actual people cost in terms of increase in headcount, which we expect will get normalized with the increased revenue growth that we have planned for next year. So once that growth happens, these upfront investments in people that we have done in 18-19 will get absorbed into the operational performance. So I don't expect these costs to stand out in next year's results. It will get normalized and we don't see the impact of it. I also want to highlight that out of the total expenses that have gone up, 18 million is also because of foreign exchange restatement of our salary costs worldwide, which is because that, when last year the exchange rate was 64, now it is at 70. So the difference of 6 rupees, but that's par for the course because we've assumed we've got the gain on the top line itself also. So the summary of it is, while the numbers that have been published look as though the profitability is under pressure, the reality is the profit is extremely healthy at an operating level. The real issue is that we have made certain strategic investments. This is part of, there's no surprises, and everything is as per our plan. So there is no need to be concerned about it. We are looking at a more detailed explanation and context during our investor and analyst meet that we have planned for end of this month. So at that point, we will provide a larger context and deeper explanation we're treading carefully between what is healthy to be revealed and what is not healthy from a comparative point of view. We will make the right balance and present that. So that's the summary of it. And of course, I will rely on your questions to clarify my statements further. Stepping back in terms of our overall business performance, the standalone growth has been only 10%, and that's because the quarter last year was an extremely good quarter, and as a consequence, the growth of 10% is on a run rate basis seems to be lower, but you need to normalize for the fact that we had a very good quarter last year. Without going into the specifics, I want to say that October, November were weak months, but December was an outstanding month, and we're continuing on that trajectory. So therefore, my expectation is the third quarter would be far better than the fourth quarter will be far better than the third quarter. Now, the fact that we have grown at a consolidated level at 13%, where the standalone is 10%, is a reflection that we are gaining some significant traction in our international markets. I will start from Australia and move all the way to North America. In Australia, our organic growth in Elgi Australia has been very good. We've got some good traction. Pulford has been an added entity for this year, which was not there in the previous year. Pulford, by and large, is tracking to performance. There are some challenges in terms of timing of conversion of orders, but the team has assured us that these are normal and there is no big concern there. Coming into Southeast Asia, it is almost at marginally better than last year, nothing significant, but we expect that the balance of the period will be a good thing. So there will be growth in that region as well. India has done exceedingly well for us, except for all the verticals have done well. The exception has been Waterville, and there it's not because the company has not done well. The overall market for Waterville has been quite subdued. Compared to last year, our share of the market has significantly improved, so we are on the right track. And if and when the market picks up, we are in a good position to gain a reasonable share of that market. So overall, India's story has been pretty positive. Middle East has been a significant challenge. There were issues with receivables at multiple locations over the last couple of years. So as a consequence, we consciously decided to curtail shipments and pull back supplies, and that really affected us. But this is, in the larger context and the longer-term interest of the company, this is a good thing. We are working on multiple means to bring the receivables down. They have come down, but we still have some ways to go. On a longer-term basis, we have taken UAE as a market where we're going to go direct because we've had challenges with existing distributors really not committing themselves to the market in spite of repeated attempts to partner with them over the last year and a half. So that has also contributed a bit to the cost because we have added to our own sales and service team in that country. The results are yet to come. I'm very confident 19-20 we will see results, but some of the costs have been front-ended in 18-19. Moving to Europe, two segments of operation. One is the Rotair operation, which is more than Italy worldwide on portable compressors and the other two products. Rotair has done well, but their growth rate has not been in the same rate as last year, which was a significant growth. But they have grown, and they are doing well. And besides the U.S., we have gained certain markets other than the U.S. As far as Elgi's products in Europe is concerned, we are continuing to grow at an extremely good pace. Things are very positive. We've got a European leader in place now, and we expect that 19-20 will be a period where we will start exploring our strategic direction for Europe. This will also be consistent with the fact that we are participating in Hanover, which is a significant European show where we'll be showcasing our products. So it'll be a good starting point to start drafting out our strategic direction for Europe in 19-20. Coming to the U.S., the not-so-good story has been the performance of patents. It has been disappointing in relation to our expectation, but that's exactly the reason why we created the initiative. We have understood the weaknesses and where we need to bring in certain strategic support. I'm very confident that 19-20 will be a year of consolidation for patents, and 2021 we expect to see significant improvement and significant growth in performance. 19-20 itself we will start seeing growth. 2021 we'll see a significant uptick. Elgi US as a standalone non-patents territory has been outstanding for us. We are growing at significant double-digit percentages, and with the additional initiative that we are doing through process and strategic go-to-market processes, we expect 19-20 to be better than 18-19. Brazil continues to be a challenge. We have done significant reduction in costs just to keep the operation at break-even. We are very close to that, but the projections are with these elections in place that next year the economy will come back, and we are doing this very carefully because the payment systems in Brazil are very dangerous, so we need to be very careful. So we're being very cautious about it. So this is really the summary of our performance across the regions in the world. In terms of markets, India for most of this year was very positive, but we're beginning to see some hesitation in terms of conversion. So conversions are taking longer. Enquiries still continue to be healthy, but we are beginning to see that customers are taking a little longer. They're a little hesitant to put money on the table. So these are just starting signals. We'll have to wait and see whether they are just temporary and they go away, or whether this is something that everyone is going to wait and watch in terms of results of elections and the policies that are going to roll out as a consequence. We are reasonably confident that we have taken cognizance of all these factors. We are looking at initiatives that will help us grow independent of that. So I'm reasonably confident that Q4 at least will be strong, and on 1920 we are taking cognizance of this possibility, and we are seeing where all we can create new initiatives to sustain the momentum. The rest of the world, the US has been on a hot streak for too long. Such a large economy growing at 3% is something, and for so long, is something that is causing a lot of concern for most of the people in the know of things. So they expect that there will be a slowing down in 1920, but we don't see the impact of it yet. Europe is not so unstable. I think we will continue to see some good movements in Europe. So this is really the summary of the markets, our performance, and the financials. So if there are any questions, I'll be happy to answer them. Thank you so much.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question at this time, they may please press star and 1. Participants, you may press star and 1 to ask a question. First question is from the line of Vinod Chari from Dolat Capital. Please go ahead.
Good morning, Jairaj. You summarized markets very well. In your closing comment, you mentioned that while US is not showing any signs of slowdown as such, despite a rapid growth, you mentioned that Europe might see some kind of a recovery from the bottom, if my understanding is right. What gives you that confidence that Europe is going to recover? I mean, have you seen more inquiries coming in from Europe, or has the level of activity started picking up at the ground?
Vinod, Europe is not, I think the recovery of Europe started 2 years ago. What I was mentioning is that it did not grow at the pace of the US for everyone to be concerned that there could be a slowing down. So the recovery from Europe has been very, has been moderated. So as a consequence, everyone expects that there will be continuity of this moderated growth.
Okay, fine. My second question is, I wanted your view on the domestic capex cycle. You yourself mentioned that standalone, you're growing slower than the consolidated entity primarily because the traction is much higher on the international side. So if I have to look at the capex cycle over a longer term, and it has gone through an up cycle, say from 2005 till 12, and then probably a prolonged down cycle across industries, more on a broad-based scenario. So as of today, where would you put your finger in terms of where the cycle is, in your own personal opinion?
That's a very difficult question. I'll try to answer it with some anecdotes. The first point is the quarter of third quarter was the standalone or the domestic sales was not, I wouldn't say it's bad, but it's the growth rate compared to the previous quarter it looks lower than the consolidated, primarily because the third quarter of last year was a very strong quarter, right?
Okay.
The timing.
Yeah.
So I wouldn't say that there is a slowing. The slowing down is the reason for standalone being a lower percentage of growth than the consolidated. Having said that, to answer your question about where we are, when we started, I think the journey for India's exuberance in capital formation and capacity investment started about 3 years ago in the year 16-17, and you look at our performance, we have been continuing to grow. Now, is that it would have completed a 3-year cycle by 18-19. So anecdotally, you would see is 3 years sufficient for capacity formation in a country like India. Now,
true.
One would say in a traditional sense, yes, but you look at what is the trajectory of the GDP, and in that context, capacity formation has to be a continuous process, right? So, as of now, based on our behavior of our customers, the optimism and the desire to create capacity continues to be there. That is where we are beginning to see, we are seeing inquiries continuing the same healthy rate. But there is a hesitation in terms of how the chips are going to fall in July, right?
Okay.
So I think I don't. So to answer your question, in the current trajectory of the economy, there's enough to be done in terms of capacity formation. But if there is anything that's going to happen to disrupt the growth of the GDP, then there could be some slowing down in capacity formation.
Fine. I mean, there's always enough to be done in India. I think, as you just mentioned, the will to do that or the will to commit balance sheet from corporate India is something which is very crucial for the cycle to pick up. And if I break up your business broadly into two verticals, you have infrastructure stroke government as one set of, or infrastructure stroke government project as one set of customers, and you have industry as another set of customers. My lay understanding would be that infrastructure would see higher traction because of the spending happening in the government and PSU sectors. But is traction also happening in industry, broad-based? Maybe selective verticals there might be some traction, but is there any broad-based capex recovery that one can maybe visualize 2 or 3 or even 4 quarters down the line?
Vinod, actually contrary to that expectation, in fact, it's the private sector that has given us the biggest growth.
Okay.
Infrastructure was doing exceedingly well in our construction and mining, where the investments in roads and dams and all that, civil infrastructure that the government had funded had created a demand. But two things happened. One, those budgets got exhausted, they were not renewed. And two, many of these players in this business are contractors who rely on financing, and the financing has dried up a bit. So there is a bit of a slowing down there.
Okay.
As far as the other PSU kind of investment, railways is separate, that goes with the budget, and we're continuing to grow well by virtue of that budget. But other than that, if you look at public sector enterprises investing, we haven't seen much of that, right?
Okay. Because if I look at broad macro data, what has been supporting capex has been more of government spending and the PSU capex. There is very limited private capex happening. At least anecdotally, we don't see it happening here. If you read across some of the companies which they talk about their capex. So that I was just framing that question in that context, actually.
Yeah. Well, we are seeing it the opposite. We are seeing private capacity build up.
Which verticals would you pinpoint in the private sector?
Pretty much across all, because no one vertical dominates our top line. Right?
Okay.
So we are seeing it across all industry verticals.
Okay.
If you really look at government spending, it is a lot of the government spending has not been on capacity and infrastructure. It's more of social spending. And it takes a lot longer for it to trickle down into capacity.
Correct. That's true. Yeah. Thanks, Jairam. I think I just wanted to get your perspective on the industry. So.
Thank you. The next question is from the line of Jasdeep Walia from Infina Finance. Please go ahead.
Good morning, sir. Thanks for taking my question. So could you give us numbers for growth in exports from India for third quarter as well as for 9 months?
In our standalone business, I don't have it with me. I'm quite happy to go take it offline. If you can contact our CFO, we're quite happy to share that with you.
Sure, sir. Sir, as far as pattern is concerned, it looks like there's been a change in your commentary on the way the business is performing. So till I think second quarter you were quite upbeat about patterns doing well, and now you're indicating some weaknesses in the business model which you are trying to address. So can you please elaborate why has pattern not delivered as per your expectation, and what weakness have you identified, and how are you proposing to solve it?
Well, there's nothing. Just to correct the perception that I may have inadvertently created, there's nothing new in the third quarter in patterns that has made us change our point of view. So if you look at the history of patterns, after we acquired them, we were disrupted by certain competitive moves, and we lost some headcount, we lost some customer contact. So right from the beginning, it has been a story of rebuilding patterns. We showed up some of our areas where we got hit badly. And since then, we've been looking at ways and means by which we can regrow to the past size. Now, last year, we decided that, incremental interventions were inadequate. We needed some transformational intervention, and which is what we put in place this year, starting from August, through an external consultant for process improvement. So what I mentioned as patterns thing is it is not done well in the quarters. It doesn't mean that it is done worse than in the previous quarter. It continues to remain at that same level. Not a surprise for us, because this is the reason why we have created this process, and we are quite confident that with that initiative, we'll start seeing better results in 1920.
Got it. And could you elaborate on what kind of inefficiencies that are there in the process right now, which you are trying to address through this initiative through an external consultant?
Okay. Broadly, without going into detail, Patterns was a distributor of a brand which was well known in the U.S. And as a consequence, there was a certain inertial business development that was happening by virtue of the strength of that brand and by virtue of the presence in the market for many years. Now, the minute that brand got pulled out and was replaced with Elgi, the organization went through a different phase where it had to actually go out rather than get pulled by the customer for orders. It had to go and push itself. So it had to learn new things, which is the struggle. And on top of it, we lost some of our sales and service people who are connected with the customer. So it was a combination of these two. But in spite of the drop in the drop of the brand, LG as a brand on the product side, we have performed exceedingly well on the patterns revenue side. The main problem has been on our aftermarket. Now, the aftermarket business earlier in patterns was coming in by virtue of their brand association, and when the brand disconnect happened, many of the customers mistakenly thought that patents did not have the ability to provide service. So this whole process is about going to the fundamentals of go-to-market and build processes of customer engagement, which will rebuild. And what we have found in the patents territory is whenever we engage with customers consciously and in a very determined and deliberate way, the results have been positive. So what we are basically doing is creating that entire process for making that happen.
Got it, sir. Thank you. Thank you for taking my question.
Thank you. A reminder to our participants, anyone would like to ask a question at this time, they may please press star and 1. We have the next question from the line of Aditya Bakul from Axis Capital. Please go ahead.
Hi, good afternoon, gentlemen, and thank you for taking
Good afternoon, Aditya.
Two questions, sir. First is on a data point. Is there a chance you can help us understand this incremental cost of about 14 odd crores? Can you help us understand what is the how much is the attributable to India business and how much would be on the international books?
I would say out of the 14 crores, almost 12 and a half is towards the U.S.
Oh.
Yeah.
Okay, sir. That's quite helpful.
And I just want to highlight here, in addition to that 14 crores, there is a 2 crore additional charge this year on R&D, which is more an accounting treatment. I explained this in the prior quarters. From April of this year, we adopted an accounting policy of writing off all the material that we buy for R&D purposes in the year of purchase itself. Earlier, we were keeping it in inventory and writing off only when the actual scrapping of material took place. Till such time, it was sitting in inventory. The auditors came and made a suggestion that that's not the most prudent way to account for consumption of material in R&D. They proposed a stage-based write-off. Up to a certain stage, keep it in inventory, and beyond a certain stage, write it off. We found that could be a very cumbersome process and add a potential for mistakes. So therefore, we took a pretty drastic decision to write off, and that's a consequence that we are facing every quarter of a significant write-off due to the thing. So it is really not a material thing, it is an accounting difference. We are in fact re-engaging with our auditors to see whether there is a simpler way of doing it. So next year there may be a change in the accounting policy on this.
R&D would be only a timing difference, and it would probably get normalized from Q1 onward.
Yes.
Fair enough, sir. Sir, and my second question was on ATS Elgi. We've seen that the performance has been slightly muted this quarter, and when we look at the last 10 odd quarters, we've been oscillating between that 43 to 50 crores kind of a quarterly revenue number. Can you help us understand a little more as to what is happening there, and what is the kind of growth rate you would look at in the next few quarters?
Just to give a context to this, Aditya, the automotive equipment business rides strongly on the growth of the automotive growth in the country. So the first 2 quarters of this year, we've had a strong growth in the automotive segment. It started slowing down sometime in July of this year, and the third quarter has been particularly bad in terms of the automotive market. The only segment that has been growing has been two-wheelers. We don't have a very strong presence in two-wheelers. The passenger vehicle market has been very muted. Commercial vehicles, where we have a reasonable presence, has been good, but the demand of equipment from commercial vehicles is not as much as in the passenger vehicles. So that's the fundamental reason why the growth rate in the automotive ATS has been muted. Now, we don't see, we've been talking to many of our OE customers they are also seeing a very muted demand for automobiles for the next few quarters at least. And everyone is talking about we need to wait and see how the dust settles down after the elections to see where the economy is going and therefore the consumption of automobiles. So on an ongoing basis, we have started exploring opportunities for growth outside of the automotive space, but using our own equipment, we are now discovering opportunities where there are latent opportunities for our products outside of automotive, the typical automotive vertical. These are opportunities we are exploring.
Okay, sir. That's fair. Sir, and just one last question, and apologies for probably reading too much into this. In your opening comments, you talked a little on, gaining more strategic direction in the European market. Would you be looking at an organic acquisition, or would you think that our current business and Rotair together would be sufficient to fuel our strategic ambitions there?
I cannot comment whether we have anything on the pipeline, Aditya, but our strategy overall across the world is a mixture of organic and inorganic. But inorganic is not a big chunk of our overall growth plan. Now, having said that, there is a bit of a context for Europe. We tend to refer to Europe as one entity, but in reality, it's an amalgam of multiple countries which are very, very different in their behavior, business practices, cultural stuff, and the way they perceive an Indian product with an unknown brand name. So right now, our significant presence is only in Italy. Italy is probably the third or the fourth largest compressor market in Europe. Now, strategically, if we want to grow in Europe, we need to start looking at the larger markets. Now, we have to be very careful in making choices of which country. We can't boil the ocean and play in all the European countries. It's just not possible. So we need to pick the battles we want to engage in terms of which countries we want to play in, which will be part of the strategic process. Now, to answer your question, will there be an inorganic presence? There could be, but it's all part of how it fits into our overall strategy of where we want to play in Europe. Right? And if we choose a country and if there is a strategic opportunity in that country for an inorganic presence, we will certainly consider that. But again, our inorganic strategy is not to buy other compressor companies. We are really looking at acquiring distributors and service companies like we have done with Fulford or Patents.
Sure, sir. That's quite helpful. Thank you so much, and look forward to meeting you at the end of the month.
I look forward to. Thank you.
Thank you. Reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1. Next question is from the line of Aruna Bharti from Paris, Washington. Please go ahead.
Good morning, Jay.
Morning, Aruna. How are you?
Yeah, good. You?
Good, thank you.
Yeah, just a minor clarification. This 14 crores one-off cost, what you have talked about.
Can I request you to use your handset? Yes.
Aruna, I'm not able to hear you very well.
Is it clear now?
A little better. There's a bit of an echo.
Okay, is it clear now?
So please use a handset if you're in a speaker mode, Mr. Bharti.
Yes, I am in the speaker mode, but unfortunately I don't have a handset here. Is it better now?
Yeah, go ahead. We'll try and see what we can do. Go ahead.
Okay, no, the 14 cost, what we have talked about, this is basically the cost that's budgeted in staff cost plus in other expenses, correct?
Yeah, it's people cost and process cost in terms of what we are paying to the external consultant for the process design.
Got it. Okay, that's all from my side, Jay. Thank you.
Thank you. A reminder to our participants, anyone who wishes to ask a question, may please press star and 1. The next question is from the line of Ishit Sheth from Anvil. Please go ahead.
Hi, thanks for taking my question. Sir, I had a couple of questions. One is, what was the percentage of spare sales for the company in this quarter in standalone as well as consolidated?
I should have prepared for that question. I haven't. I'm quite happy to take that offline and we can give you that detail.
Sure. Okay. Okay. So that's it from my side then. Thank you.
Thank you. A reminder to our participants, anyone who would like to ask a question at this time, they may please press star and 1. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to Mr. Kamlesh Kotak for closing comments. Thank you, and over to you, sir.
Hi, Jay. A couple of points I wanted to have your view on. How much capex we have planned for this year, and how much of that has already been invested?
Kamlesh, I think our plan for the year was close to about 90 crores, including our investment into our motor plant. We expect that we will close the year with, including the motor plant, at around 55.
55 crore, right?
55.
Okay.
5
okay.
5, yeah.
All right.
And just in line with that, our net debt position, including the debt that we had taken for the acquisition of Pulfords, is about 150 crores.
Net debt 150 as of now, right?
Including the debt taken for Pulfords. So I have to give you a context for that. Our Pulfords acquisition was about 60 crores. We had, in the last quarter, we had, our net debt position was about 130, if I'm not mistaken. So 130 without the Pulfords acquisition, so that was actually 190, so we have brought that down to 150. So effectively in the quarter, we have reduced about 40 to 45 crores as debt. So we are working on improving. There are opportunities, like I said, in our receivables as well as inventory. We are also looking quite sharply into capex, considering the overall market situation. We are looking at it carefully. So I think the cash generation from the business for the quarter, for Q4, as well as for the next financial year, should be pretty solid.
Okay. Second for Jain, on the BCG program, how you see qualitatively it is phasing out, and how you see that, how much part of that is still remaining to be completed?
Well, as far as India is concerned, the project has been completed from a design and rollout point of view. We have gained traction of that process in India, but there's continuing opportunity to further increase the traction in the market. Just to give you a perspective, we've been tracking the ROI on investments like these. We've taken very conservative estimation of what the incremental business performance has been in India because of this initiative. Like I said, I can't tell you how much we invested, but I can tell you our return on this investment has been between 8 to 9 months. And we are tracking it in a very conservative way, so it's been good. So, just answer your question, India is gained traction, but there's a lot more that we can do. We are confident that we can gain more traction. We have got the people, the organization in place. So it's a matter of execution. Based on the success of what we have been able to achieve is really what we have looked at in the U.S. in terms of basically a go-to-market. The design of the U.S. program is still another 2 months away, design and piloting. And then 1920 will be really the year in which we roll it out in the patents territory in the rest of the U.S. And that's when we'll be able to look at the actual gains. Now, we've done some estimates based on expectation and the cost. We believe that the ROI in the U.S., it won't be 8 to 9 months, it will be probably around a couple of years. And this includes the investment in people as well. Yeah.
And Jay, how much part of this total cost has still to go? I mean, is it significantly done, or still a major part of that is still to come?
Like I explained, Kamlesh, we are looking at the total cost. We wanted to spend it. The program is for 8 months. It started in July, but we wanted to pay them over a 2-year period. So this year we would have paid about half, and the next year will be half. Yeah. So the cost towards that will continue into next year as well.
And entire US would come over the next 2 years, 20 and 21. US, the rollout of this will happen 1920. We'll start seeing traction there and continue to improve over the years.
The cost also will go commensurately in those 2 years, right?
No. The cost will be only 1920. It's a fixed cost. Got nothing to do with our increased performance. No.
Got it. Okay. Got it. Okay. Fine. Aman, any more questions?
Yes, sir. Actually, we just have one more question, which is come up, which is on the line of Vipul Shah from Sumangal Investments. Please go ahead, Vipul.
Hi, sir. Can you break up what is the service component in this revenue?
There was a question earlier, Vipul, that I don't have that number in front of me.
But can you give any rough estimate, percentage-wise, 15%, 20%, or something like that?
It's very different in our standalone, very different from our consolidated. I would venture a guess that our standalone business is at around 22%, 22 to 23%, and our consolidated would probably be 10 to 11%.
So that will be for only our products, or we do any third-party service also?
In India, we do only our products. In patents and Pulfords, we do other people's compressors as well. Rest of the world is only our products.
Okay, sir. Thank you and all the best.
And your question was service. I can't break it up because this is aftermarket consolidated.
Yeah. Okay, sir. Thank you.
Thank you. So that was the last question. Mr. Kotak, would you like to add any closing remarks?
On behalf of Asian Markets, we thank everyone for joining for this call. Special thank to Jairam and his team for providing us the insight about the company's business and financial performance. Any closing comments, sir?
Nothing, Kamlesh. Thank you so much for organizing. I appreciate your continuing to do this. I look forward to seeing you end of this month.
Sure, sir. See you. All right, fine. Thank you, everyone. With that, we conclude the call.
Thank you. Bye.
Thank you very much.